Silver and gold closed this week a bit higher than last. The silver spot price is just over $14.60 an ounce in fiat US dollar terms, while the gold spot price is likely to close around the $1,286 per ounce mark in fully fiat Federal Reserve notes. The gold-silver ratio remains currently at 88, a more than 26-year high level. Last time the gold-silver ratio hit 90 was in early 1993. This week, we are pleased to welcome a new guest to this Bullion podcast. I think you'll find his insights on China, the current financial climate, and bullion bullishness insightful. Tavi Costa from Crescott Capital will be joining us after this brief message from our show's sponsor. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. Having now served over 100,000 customers around the world with over 10,000 positive online reviews, SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. You can also choose to purchase various qualifying gold and silver IRA products, which can be held in your individual retirement account for long-term wealth preservation. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information. Welcome to this week's Metals and Markets podcast. I'm your host, James Anderson of SD Bullion. With us this week is a first-time guest to the show, Mr. Tavi Costa, a global macro analyst for Crescott Capital is here. Tavi, thanks for taking the time and welcome to our show.
Thanks for having me, James. Appreciate it.
Sure thing. Is it Tavi or do you go just by simply Tavi?
You can call me Tavi. Tavi was just, I just realized over the years that it's a little bit more difficult to say my name as Otavio. A lot of people struggle saying that. So Tavi would be the short version of it.
Tavi's the gringo-friendly version. I got it. Cool. All right. So let's dig into this. I wanted to get the listeners to understand a little bit about your background and give you maybe an introduction of who you are and what you do.
Sure thing. I was born and raised in Brazil and moved here right in the midst of the whole global financial crisis. I was recruited to play tennis in college at D1 Liberty University in Virginia. Then I moved to a private school in St. Louis to finish my bachelor degree, and then moved to Denver and started working at Crescott Capital about 5 to 6 years ago. And initially, my job was more focused on emerging markets research, and then I kind of graduated from that and started covering more the global macro side of things. And today, along with Kevin Smith, we manage Crescott's portfolio. It's a global macro and long, short, and large cap strategies. And as part of the investment process, I mostly build a lot of macro and equity fundamental models, and which helps us to develop macro themes. Mm-hmm. It's probably one of the most important things I've built in terms of that in Crescott is Crescott's macro model, which we can always get into that, but it kind of helped us to figure out at least where we are in the business cycle.
Mm-hmm. Mm-hmm. Yeah, we'll certainly get into further detail. I guess, I've been watching you over the last year or so. I've been seeing a lot of your interviews. It seems you have a lot of commentary on gold, and I figure that's where we should start, being a precious metal related podcast. I wanted to get perhaps your perspective and the perspective of Crescott at the moment on gold.
Absolutely. Yeah. I think our perspective on gold and precious metals always links back to our views about the global economy and most of the imbalances that we see today. And China has really been a kind of like the a key role in driving growth worldwide since the global financial crisis. And now we're kind of seeing this the reversal of that China's economy presents multiple signs of weakness and stress in their economy, and one of them being the current account that is shrinking massively over the years. And we're starting to see that impact in global growth in general. So the world really has never been this indebted. We've never seen the financial system this leverage in history. And this is, in absolute terms and relative terms, relative to GDP terms. And at some point that will prove to be unsustainable. We just don't know when. And at the same time, you have things like U.S. markets or equity markets that are record overvalue in, what we see as 8 fundamental factors and so many other things. And the signs of us being at the top of the business cycle has never been this apparent. So eventually all hell is going to break loose. And I think that makes us very optimistic in gold and precious metals in general. And but first and foremost, it's mostly as a safe haven asset aspect of it that is of a possible upcoming recession globally that I think we think the precious metals could benefit from that.
Certainly. So first and foremost, a portfolio diversifier is the first thing that you all see it as, and then maybe eventually something that outperforms other asset classes as perhaps another financial crisis comes about.
Yes, that's right. I think that's if there is an inflationary part of it in the cycle here as the cycle turns, which we only have seen. Not that we only have seen that, but we've seen this in decades like the 70s or so. And if we do have that, obviously that would be the cherry on top of the whole precious metals long trade. But regardless, given all this macro imbalances that we see in the world today, we see tremendous values on precious metals, mining stocks, and others as well.
Mm-hmm. And I did see a little bit of detail about you guys keying in on the Yuan. If you don't mind, just a little bit about why that's so important to you guys in terms of its relation to gold.
Yeah, well, it's important because if you look back in history of emerging markets, having credit issues like we think it's likely to happen with China, that tends to be a positive time to own gold in local currency terms. And people tend to say, well, gold hasn't worked in so many years. Well, it hasn't worked in dollar terms in the last years or so. But if you're a Brazilian, if you're from Argentina, if you're from Turkey, you know that gold has been working. It works very well when there's a currency crisis, and that's kind of what we're calling for here. China has been, sort of the world's manufacturing floor for so many years, and kind of a major export-led economy. And as I said, now we're seeing the current account shrinking significantly since 08. And even in a more macro stand, if you looked at Asian exports plunging today by over 9% on a year-over-year basis, and things like we all know that China's economy depends so much not just on exporting but also on things like infrastructure developments, and one major part of that is iron ore, and we're seeing now iron ore imports. They're actually dramatically diverging from nominal GDP in China, and then the usual counter argument for that is that now China is focusing more on consumer demand driven part of the economy, and that's not really true actually at all. Especially when you looked at things like retail sales at its lowest levels since the early 2000s, and car sales plunging, and so forth. And the one part of China that is interesting is that the whole this debt buildup that we've seen. It's a $45 trillion banking on balance sheet assets that we're seeing in China, which it's huge when compared to a $14 trillion economy. Mm-hmm. So, if you looked across, the last 100 years or so, China created 9 different currencies in history and for the last 100 years, and all those 9 actually became worthless. I should say actually 10, right? The last one is Yuan, but the other 9 ones became worthless. And why is it different this time? We don't think it's different at all. And you looked at other imbalances like in the Chinese market in general. If you look at public equities, just the non-financial stocks in China and Hong Kong, you have to aggregate both because it's a lot of those companies, have businesses in both places, and they're essentially almost like same country, really. But if you aggregate the free cash flow for the last 12 months for those companies, and you also aggregate the liabilities, it would take those companies over 74 years to cover their liabilities today, given how much they make in free cash flow on the last 12 months. So, talk about throwing capital into very unproductive assets. I think that putting that all together, it seems to us that the Chinese currency is likely to devalue, and gold is likely to do very well in a situation like that. If you looked at the gold in Yuan terms or renminbi terms across the years, it's been kind of pegged for the last 3 years, and it's now breaking out from that, kind of flat line, and we think that that's poised to go much further on the upside. And we can even talk about our macro trade of the century, which is that, and selling global stocks. So essentially owning gold in renminbi terms, but at the same time selling global stocks. So there's a lot of exciting parts of here, but I think that's China is really at the center of a lot of these imbalances, and it's very important to understand how that's going to play out.
And if you don't mind, I mean, it's kind of deep in the weeds. Maybe it's proprietary. Maybe it's something you guys can't comment on. But if you're going long in Yuan terms, like what's a method that you might use to do that?
Sure, I don't mind sharing that. We letter out a few put options. So we're long put options, or we should say we're long call options in USD, CNH, and we letter them out in different time frames and different strikes. And we also have the same for the Hong Kong dollar, which is it's insanely cheap given the implied volatility of especially the Hong Kong dollar is so low. So betting against those currencies it seems like a smart way to us to really get exposed to that. So being long, or being short Yuan, and at the same time being long gold in dollar terms will obviously give you that gold in Yuan terms exposure.
Yeah, that sounds like a good risk reward profile, given all the things that we just heard from you. I never knew that, by the way, about the 10 various currencies over the last 100 years, that 9 of them have come and gone. That's pretty good, and that's something I've not heard from anyone else. So very nice point there.
Yeah.
And I wanted to get perhaps other perspectives. Is there any commentary you might want to make on maybe silver or platinum or perhaps even palladium?
Yeah, well, silver obviously is the high beta version of gold, but sure. In looking at silver to gold ratio at its lowest level since the early 90s, and if we're bullish on gold, we're obviously very bullish on silver. We hold some silver positions. Platinum, we don't have it right now. We've been in and out of platinum. It's just because we try to stay within our limits of how much we can own of precious metals, especially right now in the portfolio. We always had precious metals in the portfolio as a sort of an insurance of this, how we think that global fiat currencies will at some point lead to value destruction, and gold will likely to be the ultimate asset that will benefit from all that. But going back to that, you can look at Russell 3000 total return, which is kind of like a U.S. broad stocks index, and looked at that relative to silver ratio, for instance, and it's kind of retesting that 2000 insane levels that we had of valuations for U.S. equities during the tech bubble. We just retested that same level of Russell 3000 versus silver ratio And given all this imbalances we see, not just globally but in the U.S. as well, it's kind of for us, it's silver it looks very, very interesting, and we think that ratio is going to drop much further, and obviously it will be probably because of a sell-off in U.S. stocks, but also it's going to be a possible rise in silver prices. So I think that's, and you can see that relationship too, and with mining stocks. And if you look at the S&P 500 versus the Philadelphia Stock Exchange Gold and Silver Index, that also looks pretty toppy. It actually topped out in 2015, and it started to fall during the December sell-off in 2015 and stopped in. But gold and silver mining stocks, kind of kept going after, even though equity markets kind of, I wouldn't say bottom, but at least kind of proved to be just a correction of the 20% correction or so. But gold and silver mining stocks continue to go up during that time, and but now we're kind of retesting the same those same levels, and it looks also very attractive to us, the mining stocks part of it.
Mm-hmm. Sure. And, people, for a while now, there's been a lot of fundamental reasons. That's many that you've cited already in this interview. For years, there's been fundamental reasons to be bullish gold. But, timing-wise, obviously, is always a huge question. When is, the mantra, right? So why specifically now? Why timing-wise, why do you think now is more prescient than perhaps prior?
Yeah. So most of the things that I was talking about so far, I would say, even valuation and the debt imbalances globally are mostly kind of a long-term picture. We don't know when those things are going to become relevant. Nobody knows. And but what we're seeing today that is kind of interesting. First, we had a kind of a breakdown in the real yields, especially 5-year yields. Real yields, and from a multi-year support line, and it looks more and more decisive to us that breakdown will continue. And if you looked at that, real yields inverted, it follows gold prices very closely. So if that's likely to continue, you would expect gold prices to pick up as well. And that's mostly being caused by nominal rates. 2-year yields I think it's a huge, not just a good macro indicator and factor that everyone should be looking at, because if you look back in history, when 2-year yields start to fall significantly, especially when you draw a line on a logged version of 2-year yields, and you draw this multi-year resistance line connecting all the tops from me, and every time it touches that top and starts to or touches that line and starts to fall significantly, we tend to be at the peak of a cycle. We had that in the double dip recession and the tech bubble and global financial crisis, and we're seeing that again today. And that's really been caused by the credit markets that are pricing in that the Fed is going to start to ease sometime soon, and that's that's causing nominal rates to fall, and therefore causing real yields to fall, and perhaps could be a reason for why gold now. But there are other reasons. The other thing is global yield curve inversions. So when you have inversions in the yield curve, that tends to be very positive for gold. Today, we have many ways to look at that. Well, one of them is just looking at the global yield curve inversion, which is just looking at 30-year yields versus the Fed funds rate across the globe. And there are about 15 economies have those two, the spread of that inverted. Think about that for a second. It's 30-year yields versus overnight rate that is inverted in 15 economies. It's insane. And then But another way to look at that is looking at the yield curve in the U.S. So, we calculate a very comprehensive model of looking at more of all the 44 possible spreads in the yield curve in the U.S., which shows that about 55% of the yield curve is inverted. And, but that, or just look at the short duration yields versus the Fed funds rate that are inverting. The 3-year yields, the 5-year yields, they're all inverting versus the Fed funds rate. And those, when they invert, first of all, they tend to be kind of at the peak of a cycle, right? Mm-hmm. The second thing is it tends to happen, and we don't know, some inversions, when they happen, they actually tend to link exactly with the peak of the equity markets, especially S&P 500. But you don't know if it's going to take 1 or 2 years. But the one thing that tends to happen is that gold to S&P 500 ratio tends to rise when inversions happen in the yield curve, especially on short duration yields versus the Fed funds rate. So we think that is very bullish. And as I mentioned, all these things, we have our Crescent's macro model. It's a 16-factor macro model that includes economic indicators and fundamental factors and a few technicals, and it's a very simple way of looking at the markets, and it's being pointed to us that we're only 2 percentage points away from record overvalue levels for the U.S. markets. And you put it all together, all the things that I just laid out, and at the same time you see gold implied volatility near all-time lows. Right. So I just don't see any, for me that's nonsense. And it makes for me it proves the point of why you should be really only gold today. And I've never been this excited, and I should say in the name of the fund, we've never been this excited about precious metals in general, and we do hold a significant amount of the portfolio on that.
Yeah, I mean, you did mention people's expectation that perhaps the Fed, obviously they reversed course after that December scare in the stock market. It sounds like they're going to pause, maybe no more rate hikes, and perhaps even people are expecting they may roll over to QE at some point if there's further volatility in the financial markets. Are there any curveballs, for instance, that you're really keying on? I mean, there's all this talk about things like that are just, I mean, we never thought we'd ever see ZERP. We never thought we'd ever see, negative interest rates, NERP. We never thought, probably never thought QE was ever going to be possible if you asked anyone in 2005 or so. I mean, when you hear people talking about MMT or, other types of things like this, we have bank bail-in legislation that's out there. People probably don't even know about that in the United States or in the G20. Are there any things that you're looking at out there that are curveballs that maybe people aren't eyeing on that you're paying attention to?
Yeah, I think that another important part is obviously we've seen a lot of money printing throughout the last few years that have, last years or so since global financial crisis, that have had a huge impact in inflating asset prices, especially equity prices, but just private equity too, and house prices and so forth. So we're seeing the kind of distortion in prices all over. But there's another part of it that is now looking really interesting for gold and just for looking at the world is if you looked at global M2, just the money supply on a year-over-year change basis, and or central bank assets and globally as well on their year-over-year change basis, what you see is that there's a contraction happening today, which never, you can't really go back much further in history on this. It's hard to find data going back a lot, but we can find a time in history that both of those indices are contracting on a year-over-year basis, and that not even global financial crisis that happened, and that has been kind of a very an important part of our bearish thesis as well. And obviously at what point if markets really starts to fall apart here, equity markets I'm talking about, well then you would expect things like you just mentioned, right? Some sort of central bank intervention. We all know that they always resort back to or tend to resort back to some sort of either money printing or interest rate cuts to help the cycle, but that never really prevents the cycle from turning. You can see that by back in 06 and 07, global central banks were actually printing money right before the global financial crisis began to unfold. I think was somewhere close to $3 trillion of assets that global central banks really added to their balance sheet during the time. This is before the first QE from the Federal Reserve, and not even that really saved the markets from collapsing. So I think that's been kind of I think that's a real fallacy of pundits and market people that have been watching the markets have been supporting this bullish thesis that if Fed will cut rates at some point, that will be bullish for the markets. Right. I don't know any time in history that we have such record valuations like we have, and so many signs of showing that we're late in the cycle, and that the Fed, if the Fed cut rates, that would be just an acknowledgement of weakness in the markets, and I can see that being positive at all. Look back in history, every time that happens, it tends to be very negative. So again, it goes back to our negative outlook for global stocks in general, especially U.S. stocks, and you can find other issues in Canadian banks and Australian banks and so forth. We can go on and places that you can find lots of imbalances and kind of a historical overvalue issue that links back to other previous market peaks and bubbles that we've had in the past.
Mm-hmm. Are there any other sectors that you guys are eyeing or perhaps positioning in that might be interesting to listeners?
Sure. I think that there's I wouldn't call it obviously a sector, but another interesting idea for a lot of your audience that we think is kind of interesting is looking at things like U.S. yields versus German bond yields. And, one way you can look at that, the 5-year yield spread between the two, they have a very interesting relationship. Every time they start falling apart significantly, when I say fall apart is you can, create that spread throughout history, like go back all the way to the 90s and kind of go back to the very bottom of those spreads, and then kind of draw a resistance line or I should say a support line for those. And every time it breaks down from that support line, and it breaks down kind of with authority, you can see that you're at the end of the cycle. It's kind of an uncanny relationship, mm-hmm. and we think that the 5-year yields tends to kind of lead that. We already saw the 5-year yield spread between those two instruments kind of breaking down. But the 10-year yield spread between the two, it's kind of like used to be the Bill Gross trade, if you remember. Bill mm-hmm. Gross used to say that, buy treasuries and sell German bonds. Mm-hmm. We like that trade quite a lot as it tends to develop, and it's mostly caused by a divergence of monetary policy between the ECB and the U.S. And you can see that relationship as well looking at Euribor and LIBOR spreads as well. Mm-hmm. And so, I think that it seems to be another way of protecting your portfolio. And in our view, we think that spread is likely to narrow much further as it did during previous unfolding processes of bear markets.
Mm-hmm. Now, obviously, you're looking out in the 2020s. You've obviously mentioned that you guys are very bullish on precious metals at the moment. Are there any other, as far as the fiat currencies that you have your portfolio denominated in, are there any that you guys see as being a safer haven versus the other? Because, many would argue that they're all going to be debasing versus real things. But is there any fiat currencies that you guys perhaps prefer fundamentally?
As far as our view on currencies, we obviously, even though we have a very bullish case for gold and precious metals, we don't necessarily dislike the dollar. We favor the dollar versus Asian currencies, especially, as I said, renminbi and the Hong Kong dollar. Mm-hmm. But the whole idea of liking, for instance, Japanese yen, we're very I wouldn't say so much agnostic on that, but at least we don't really buy into the idea of being a safe haven. We much rather own dollars versus almost any other currency in the world today, besides gold, obviously. So I think that if we're kind of believe that this dollar squeeze sort of thesis from other money managers, we think that's likely to play out, especially now Trump pushing. We're becoming more of some sort of fixing the current account issue here in the U.S. You have all this dollar-denominated problem of debt mm-hmm. problems in the world, and all those things would at some point become bullish for the dollar. And you can see that as well by looking at spread between yields. Remember that spread of 30-year yields versus the Fed funds rate. Right. That is kind of interesting, that inverted among 15 economies. Well, that shows you a lot of things. One of them being the global yield curve inversion, but the second one really is how high are U.S. interest rates relative to global rates. Perhaps there is some sort of imbalance there too, and you would expect some inflows to U.S. Treasuries at some point that because of that, and it could drive the dollar up too. Mm-hmm. So I wouldn't say dollar is a safe haven at all,
Right.
but we favor the dollar versus a lot of other currencies, and I think there is a point to be along the dollar and long gold at the same time. Obviously, not long gold. You get my point. We're long the dollar, especially versus Asian currencies
Sure.
that we think are likely to devalue and even enter a currency crisis, as we haven't seen that in a long time.
Right. Since around 1997 or so.
Yeah, well, China had one in 1993, which was very interesting. It lost 1/3 of its value on one day.
Seriously.
And
Wow.
yeah, it's those things can happen, and it happened throughout history. And
Wow.
I think people tend to forget those things, and everyone should look back in history and see how the Chinese government tends to reset its monetary system many times throughout history, and so it's important to understand that and think, why is this time different? So given again all these issues that we see in the credit imbalances in China.
Yeah. Well, Tavi, I really do appreciate you coming on our show today, and I wanted to give you the chance to let our listeners know how they can find you and follow your work.
Yeah, absolutely. Well, our work is mostly, we're kind of very we post a lot of things on social media, so we're very active there. So I guess the at Tavi Costa is my handle for Twitter. Crescat at Crescat Kevin is Kevin's Twitter handle as well. He's also I would say very active, and I've been kind of posting a few things on YouTube. I have a YouTube channel. You can just type Tavi Costa. You'll find a lot of my videos there. They're short videos. They're just trying to show a few of our views and hopefully share the word and some of our work out there. And LinkedIn, I'm very active there too. But our website, crescat.net, has most of our work or letters, and you can sign up for a newsletters and you can receive that on a monthly basis. We send a lot of research. We put out a lot of things, a lot of content, and hopefully good quality content that hopefully your audience will enjoy. But yeah, I think that's our biggest thing right now is to really use social media to share our views and how we see the world. I think that's very important.
Well, Tavi, we really appreciate it. We'll be certain to backlink a lot of those things for listeners if they want to find you and find your website, et cetera, in the show notes. So thank you again for coming on this week's Metals and Markets Wrap.
Thank you very much, James. I was glad I was here. Thank you.